All right, we are on chapter 6. We are still talking about inventory, and everything that we learned in the previous chapter will still hold true. We basically learned how to do the journal entries for inventory back in chapter 5, and now we're going to learn how to count for inventory on these different bases of accounting, and they're LIFO, FIFO, and average cost. And we're going to do a lot of math calculations. So a lot of students tend to think this is a more fun chapter. So we are going to do learning objectives 1, 2, and 3 all separately. And then I will throw 6-4, 6-5, and 6-6 all in one. They're super short and they'll do good for one video. Okay. All right. So let's get started on learning objective 1. So, a couple of things that we need to think about when we think about merchandise inventory. Remember, it's an asset. It is a current asset, okay? Because we plan on we plan on selling all that inventory within the coming year, okay? So, I have a couple of things that relate to inventory with consistency, disclosure, materiality, and accounting conservatism. So, let's jump here to consistency. We're going to learn a couple of different bases on how to account for inventory, and GAAP says businesses can choose whichever one they want. Okay. But they do have to be consistent. You'll see how some methods of inventory will affect the financial statements. And so businesses can't just bounce back and forth between these different um, ways to keep up with inventory. Okay, has to be consistent. So if a company does decide to change how they're doing inventory, they have to actually go back and restate all the prior period earnings. Okay, so they make it very difficult to change. And if you do change, you've got to do a lot of extra work. Okay, all right, then disclosure. We want as much information on in the financial statements that will help investors make good decisions. Okay, that's the biggest thing. Anything that would change an investor's decision falls underneath this disclosure principle. It has to be disclosed. And you will notice that if you ever picked up like a Walmart, Best Buy annual report, it's over 100 pages. There's only 4 or 5 pages that actually have numbers. There's a lot of notes to the financial statements. Okay. So then let's talk about materiality. The example I usually use is like for me and you, $100 is probably very material. If we lost $100 today, that would be material for us. But for Walmart to lose $100, probably not that big a deal. Kind of falls underneath that materiality concept. When I was a bookkeeper at a hotel, I had, when I first took over, the previous bookkeeper had not done a lot of the work. So we like wrote off like $70,000 in credit card charges. They were credit card fees, not charges, but fees. And then the next year I was upset because I was 17 cents off. And my boss said, just it's immaterial. Just make a journal entry, fix it and move on. We wrote off $70,000 last year. We're good with 17 cents. Okay. So that kind of explains materiality. Okay. And then conservatism, please do not confuse this with a political affiliation. 'Cause that's not what we're talking about here. So in conservatism in the financial statements, we want to always anticipate no gains, but all probable losses. So anything that we're going to always be conservative. Um, Always going to record something as a liability, not going to record the gains that we just anticipate. Okay. We're trying to make the financial statements look as the worst picture possible. Okay. That's conservatism. Okay. Because it's much easier to come back and say, oh, we miscalculated, or, we didn't anticipate this much gain. And here we go. Things are going to be better. Okay. Um, Record an asset at the very lowest reasonable amount, not the highest, or a liability is the highest. Okay. When there's a question, record an expense rather than an asset. Okay, so in this option, it undervalues rather than overvalues the business. Okay. Inventory is it's a lot of controls over inventory. If you think, especially if you think about inventory that's a very high dollar amount, like computers, just thinking a warehouse full of iPhones, things like that. Those are very high dollar items. Okay. My husband used to be the inventory control manager at a facility in Little Rock. And every time I would go in there through the guard shack and come out, I would always have to pop my trunk and show them there was nothing in my trunk. So to make sure I didn't steal anything. And if I did have something, sometimes we would buy stuff from there. If I did have something, I would have to have an invoice or show where I purchased that. Okay. So that's a control over inventory. I know in some warehouses where things are little, they have to go through a couple of checks, not just like a little guard shack like we had there. Okay. And if you have any inventory that gets damaged, you want to make sure that there's entries being made to take that out of the inventory. A lot of times that's where if you went out there and counted the inventory and you looked at what was in the computer system, a lot of times it's damaged. It could be theft, but a lot of times it is damaged and it just didn't get the journal entry to take it out. Okay. All right. I've kind of talked about data analytics. Um, they're just kind of hitting on it every single chapter because it's such a big deal now. We have lots of information and we can make a lot of decisions with that information. Knowing what decisions and knowing what data to pull is probably the biggest hurdle because we just have so much data now. It's just crazy. Okay. All right. Before I go to the next objective, I want to jump over here and I want to talk about these three things: FIFO, LIFO, and average cost. Okay. So under FIFO, I want you to, this is my swimming pool. Okay. You have a water hose going in. So the first water that goes in is going to be the first water out. So think about an inventory item that has to be rotated on a FIFO basis. Anything that's perishable, all kinds of food, that stuff has to be rotated on a first in, first out basis. Okay. But if you think about the pool water hose going in, first water in, first in is going to be the first out. Okay. Now we're going to look at LIFO. LIFO is the last in, first out. So I always think of this is a pile of dirt. If you keep putting dirt on top of this big hill of dirt, you're not going to remove all the dirt on top just to get the dirt on bottom because it doesn't really matter. It's dirt. The longer it sits there, probably the more valuable it is. So the last load in will be the first out. Okay. Then average cost. I'm talking about physical flow. In the next objective, we are going to talk about the actual dollar flow. Okay, so don't get too confused. I've got my pool again, and if we have a water hose going in, and now let's say instead of a drain in the bottom, we have a drain going out the side. All of it gets mixed together and it just comes out as an average. Okay, so these are physical flow of the goods. FIFO is first in, first out. LIFO is last in, first out, and average cost. All right, there is one more. We don't go into it really deep, but we'll talk about that in the next video.